500,000, and then you lose 40%, that hurts a lot more, especially that you're 56. But if you can diversify out of a lot of that risk, where your line is for the most part positive, but it generally tends you in the same direction, that's the benefit of choosing asset classes that act dissimilarly. They don't do the same thing in general. And that colorful chart in the middle of the table, I'll give to you later if you'd like a copy, it tells you what all the asset classes have done, and you can see the difference. Where one asset class is high, sometimes the same opposing asset class is always low. And you want to be in them. Here's an example of it. The S&P 500 index from 71 to 2010, and this is not in here yet, I don't think, we'll get to it, is 11.75% return with an 18.09% standard deviation of risk. If you add the international equivalent of the large companies, so they call it EFI, Europe, Australasia, Far East, if you take 70% S&P then and 30% of EFI, you increase your return and you decrease your risk. And then you add small companies internationally out of the 30% here, and you increase your return more and you decrease your, you keep your risk a little lower. Now these are just equity asset classes. If you mix in fixed income asset classes, you get to see the risk come down even further, which we'll illustrate in a couple minutes. Does that make sense?
Does the return go up or stay the same with those?
With the fixed income, it does go down some. When you put fixed income in, you see the return go down some, but you'll see it's not that much compared to the benefit of the lower volatility that you get. Okay, so that was the philosophy and the theory. The practical underpinning on this is where returns come from. And we look at the three-factor model. We look at market, company size, and value. All right. We know that the market gets a return unlike CDs or treasury bills or cash. Right? The stock market gets a good rate of return over time. And it's riskier. Equities are riskier than fixed income. Right? Fixed income equals bonds, equities equals stocks. But they do historically provide a larger rate of return. It's not small. It's 10% versus 3.5%. So you can write these in on the first white box on page 13. So the S&P 500 return is 9.87. T-bills are 3.62. The standard deviation of the S&P 500 during that period of time is 20.39. And with T-bills, it's 3.09. So the first question in everyone's portfolio is how much of my money should be in the market and how much of it should be in T-bills? That's the first question. We know we can't retire well if we just have all our money in T-bills. And we know that we're more volatile than we need to be if we have our money in the stock market only. So that's the first question. The second question is the company size. Because we know that small companies are riskier than large companies. It even makes logical sense. We would have said that. If I would have asked which one are more risky, you would have said small companies are probably more risky. That's true. Which means that they're more volatile. They go up and down a little bit more ferociously. Small companies, though, provide a better return for it. And the numbers you can fill in there are US 9.87. And the U.S. small company, which is the CRISP market, the Center for Research and Stock Pricing, the 6 through 10 category is anything considered small, okay, 11.5. And sometimes the S&P numbers are a little different based on what we're comparing it to, because based on what we're comparing it to needs to have a different period. So don't be too bogged down with an S&P number that's a little bit different. The standard deviation of risk is 20.39, and the U.S. small company risk standard deviation is 30. But as you saw before, when we added small international companies, the risk didn't go up, even though we added a more volatile company. And that's because these company asset categories, they don't act the same, and they offset each other. So you don't add these two and divide by 2. You don't add them together. The two together equal a lesser risk because they're dissimilar in how they act. The third is the value factor. It's probably the least recognized. It's the difference between Kmart and Amazon. Okay, Kmart's a value company, always has been. No one wants Kmart, right? It's got a high book to market. It's worth a lot of money on the books. It's got a lot of real estate, a lot of buildings. The accountants think the company's worth a lot of money, but nobody buys it. The stock price is always low. So it's usually a 1-to-1. If the book value is, 10 billion, the stock price is usually equal to about 10 billion, maybe 11 or 12 billion. Amazon, on the other hand, is a growth company, which is a high book or a low book to market. The book value of Amazon is almost nothing. They don't own anything. They don't even own the books they sell most of the time. They're just positioning them from one owner to the other and collecting a little commission in the middle. They have some computers, they probably lease those. They have very little in assets, but their stock price is always high. Well, the value companies, believe it or not, get a better rate of return over large periods of time. And it's because we can buy them very inexpensively. And often enough, value companies become growth companies. And when a $2 stock becomes a $90 stock, you don't have to have that happen too many times out of 100, and you get a better return. So you get a better return out of value companies, and for that you can add these together. The annualized return in comparing the large value to S&P is again almost 2% better. 9.94 in comparison to the value.